Managed, Gilo.
Yeah, so it's live on YouTube. I can see.
Oh, nice. All right, then we can start. You can broadcast.
Well, I have to be made host again.
Oh, okay. So, Peter.
I'm a broadcast. I'm a answer. Is that way?
Mute myself, kwanza.
Okay, so we are starting the webinar. Good afternoon, everyone. My apologies for the delay. Thank you for tuning in this fine afternoon for our webinar on leading and lagging indicators. I am your host for today. My name is Gilbert and I represent Forex SPL. And in conjunction with Scope Markets, we are here to give you a little bit of an introduction and coverage of leading and lagging indicators. Now, I know some of you in the audience may already be seasoned traders. Some of you are new traders. So what I'll do, I will just give a basic overview of technical analysis. And then from there, we will dive into the indicators. So if you can allow me to share my screen, I will do that right now. So I hope you can see this, can be able to see my screen. All right, so the topic for today is leading and lagging indicators in technical analysis. Now, before we even dive into the indicators, let's just give an overview of what we're covering today. So we have to first of all understand what is technical analysis. So what I'll do, I'll just begin from the beginning with market analysis. I'll give a brief introduction about the other types of analysis, and then we'll dive into technical analysis. So market analysis is the breaking apart of information in order to make sense of it. So just think about how you want to analyze something. You'll have to break down that information into smaller bits and pieces in order for you to be able to make sense of it. And in market analysis, what we're trying to do is we're trying to figure out what influences price movement, because that is what we are interested in. In any marketplace, the first thing that you want to do is understand the market and also understand what moves the prices. Doesn't matter what kind of a market you're in, the stock market, the forex market, cryptocurrency, bond market, you want to be able to break down that information to figure out what influences the price movements. So in this case, with market analysis, we seek to understand what has happened, what is currently happening, and what will happen in that marketplace so that we can understand the decisions that we're likely to make. So we have to look at the past, first of all, then we look at what's currently happening in order for us to be able to project future price moves. So that's just the basic description of market analysis. Now, in market analysis, we have there are actually three main types, but then we can consider the fourth one as also a type of analysis. And feel free to share your comments in the chat area. And also, if you have any questions, you can post them on the Q&A section or on the chat area. And after the webinar, I will respond to your queries. All right, so the four types of market analysis that we have, the one that we're going to concentrate on today is technical analysis. And technical analysis is more about understanding price behavior, how price and volume interact in the market. The other type of analysis is fundamental analysis. And in fundamental analysis, we're looking at economic factors and geopolitical factors. So we're looking at how economic factors and geopolitical factors influence prices. So in this case, you'd be looking at interest rates or future interest rate decisions. You'll be looking at unemployment rates. You'll be looking at inflation reports. So those are the things that are in fundamental analysis, including even political events, like what was happening with the US elections, what was happening with Brexit. So all that is just part of fundamental analysis. Then we have sentimental analysis. Sentimental analysis is to do with what would we call it? We would say the attitudes that people have about the market. So are people bullish or bearish? And in order for us to identify whether people are bullish or bearish, we need to look at the trade volumes, because the trade volumes will tell us more about the supply and demand forces that are there in the market. Well, not really the supply and demand forces, but in terms of the trade volumes, do we have more supply than demand in terms of more selling orders than buying orders, or do we have more buying orders than selling orders? Now, in Forex market, when it comes to sentimental analysis, we either look at data from brokers who give the data about the positioning of their clients. So in case of Euro USD, maybe 500 traders are long Euro USD and only 100 traders are short Euro USD. That can give us an idea about the attitude in the market based off of that retail sentiment. And we also have institutional sentiment, which is under the Commitment of Traders report or the COT report, which shows us how the big players have positioned themselves in the futures market. Then we also have quantitative analysis, and quantitative analysis is a branch of technical analysis. Technical analysis has elements of visual analysis, right? But quantitative analysis is purely mathematical. So in this case, we are not using charts, we're not using graphs, we are using algorithms, and in some cases complex algorithms that break down that information that's coming into the market, mostly from the price and volume aspect. But there are also some algorithms that break down some of this data coming in from maybe from the economic point of view. So some of this, but most of these quantitative systems, they deal with price. They deal with price and volume and what's happening in the market. So these are they can be very simple or quite complicated. And in order for us to engage in quantitative analysis, you have to use algorithms. So when you hear about Forex robots, expert advisors, algos or algorithms, this is talking about quantitative analysis. A robot or a computer program does not need a chart because it doesn't have eyes, but we as human beings, we need to see how the prices are moving, and that's the reason why we need the chart. So we would fall under this categorization of technical mostly, but the quantitative models, these are computer programs. All right, so those are the 4 types of market analysis. What we'll concentrate on is technical analysis. Okay, so technical analysis. What is technical analysis? Now, technical analysis is the most popular form of analysis, and it's used by many traders, mostly traders who are engaging in short-term speculation. So if you look to trade on a day-to-day basis, then there's a very high chance that you're going to be using technical analysis. However, if you're a long-term trader or investor, so if you're long-term, you're more of an investor. So if you're a long-term investor, then you'll be concerning yourself mostly with fundamental analysis, both in Forex and also in stocks. So technical analysis is used by short-term traders mostly, and it involves forecasting prices based off of past analysis. So what you're looking at is you're looking to analyze past price movements in order to identify repetitive patterns, and then use those patterns as you come across them in future. You'd be able to project when the prices are likely to go. So that is technical analysis. Now, traders use tools to identify these market trends and patterns to anticipate future price direction. So it involves studying the past to be able to understand the market. Just like any in any field that you're in, even when it comes to weather forecast, we had to start looking at data from way back in order for us to understand any patterns. If there are any particular patterns that could basically cause, let's say, a cyclone or a hurricane, so that in future we're able to identify these patterns early and we're able to warn people ahead of time. So any type of field of science does require looking at historical data in order for you to start understanding the nature of the industry that you're in, or for you to understand what it is that you want to analyze and predict in future. All right, so traders use tools to identify market trends and other patterns to anticipate future price direction. So these tools are the ones called the technical indicators. Those are the ones that we are going to be looking at today. I hope so far we are okay. All right, so there's a point here that was supposed to be on the previous slide. So analysis of price and volume is done graphically using price charts. So that's all saying that it's visual analysis. For us as human beings, we can't just look at numbers and then make sense of them, because these numbers are changing every second. We're not going to be able to make sense of that. So what we need to do is we need to graphically represent this price movement so that we're able to identify these patterns visually. Even if we're going to be using these analytical tools are going to project themselves visually on our chart, and then from there we'll be able to make sense of what's going on. So it's easier for you to look at something and be able to identify patterns as opposed to just making calculations and you're not even able to understand what it is that you're even calculating. All right, so the types of technical analysis. Now, I hope I'm not too fast. But in case I'm going too fast, just let me know in the chat section. So next is the types of technical analysis. Now, there are two types. If you are already a seasoned trader, or at least you've researched about forex trading or stock trading on your own, you'll have gone through this first type of analysis, which is chart analysis. So usually how we begin technical analysis is we begin by trying to visually understand the chart, what's going on in the chart. And in this case, we start with candlestick patterns. This is the most basic form of support and resistance. And candlesticks, what they represent is the open, high, low, and close within a certain period of time. So let's say we want to analyze what's been happening hourly, every hour. So each candlestick will represent 1 hour's worth of price movement. It will represent 1 hour of price movement. And it will tell us what happened within that hour. It will tell us where the price was at the open of the hour, where the price was at the close of the hour, and how far high it went, or how far up it went, and how far down it fell during that same hour. So that is the most basic form of chart analysis, candlestick patterns. Then we also have chart patterns. These involve a group of candlesticks that come together to form a larger pattern. So from there, you have things like the triangle patterns, the symmetrical and ascending and descending triangles. You have the rectangles, you have the wedges, you have the pennants and flags. So there are quite a number of these chart patterns. Then we also have horizontal support and resistance lines. And this is also visual. So you can look at a resistance is a price ceiling. That is a price that the market was unable to surpass when it was going up. So it rose to a certain price, it was unable to surpass it, and it fell back down. So that price that it was unable to surpass, that is called a resistance or a price ceiling. Then when prices fall and they are cushioned somewhere down there, so they fail to continue going down, they reach a low price and they bounce off of it, going back up. That is called a support. And a support is a price floor. It's a price floor or a price cushion. And these are visual, we can be able to see them and we can be able to mark them. And there are those ones that are horizontal and there are those ones that are diagonal or angled. So it could be a moving support, almost like a slab, like when you look at a staircase. You can see the steps, but then you can also see a flat slab at an angle. So that angle cushions the stairs. or that slab cushions the stairs. So those are the trend lines, and it's a moving form of support or resistance. And we call them just trend lines, or we can call them diagonal or angled support and resistance lines. All right, so that is chart analysis. And this chart analysis, as basic as it looks, it's very powerful. It's a very powerful way of trading, and most traders, as much as they're using these technical tools that we're going to be looking at, they still merge them with this chart analysis. So that could be the candlesticks, the chart patterns, horizontal support and resistance levels. All right, so I hope I'm still audible. All right. So the other type of technical analysis is statistical tools, the use of statistical tools or technical indicators. Now, these technical indicators are mathematical tools that apply calculations to the past price and volume so as to identify patterns that could be used to predict future price direction. So whereas in chart analysis, we're kind of trying to establish where the prices are going to go just by marking the support and resistance levels, the statistical tools are calculating these prices, and they're able to tell us whether maybe we're above the average price, so therefore we're in an upward trending market, or maybe we're below an average price, and therefore we're in a downward trending market. So that's like a basic technical indicator called the moving average. So we want to identify where the current closing prices are relative to an established baseline. And that baseline could be maybe relative to an average of the past maybe 50 closing prices. So where is the current price relative to an average of the last 50 prices? So those are calculations. And the good thing about this is that they are represented visually on the chart. So you're able to see it in form of lines. So it could be lines, it could be graphs, but in most cases it tends to be lines. So those are the types of technical analysis, and we'll be concentrating on the second type, which is the technical indicators. Now, these technical indicators have different categories. So they're not all made the same, or they are not all calculating the same thing. So the larger categorization is leading and lagging indicators, and from that categorization, we then have different classes. So we have trend indicators, we have momentum or velocity indicators, we have volatility indicators, we have volume indicators, and we also have indicators that calculate support and resistance levels. So in total, we'll be looking at, these are the major four, these are the main four, but we'll add a fifth one, which is support and resistance. All right, so let's start with this classification first, and then we will look at all these indicators that are in these 4 or 5 categories, and then we'll try and place them into whether they are leading or lagging. And I'll also explain what leading and lagging means. All right, so let's begin with the first group of indicators. These are the ones to do with support and resistance. Now, support and, I think I've misspelled resistance there, forgive me for that. Now, support and resistance, you can be able to identify these levels visually, or you can calculate them. And there are indicators that calculate these possible support and resistance levels on your charts. And what we use these indicators for is to predict potential reversal points in the market. So that's the basis of support and resistance. We're looking to identify potential reversal points. And if we do not see a reversal at that level, then we can use those levels for breakouts. So either two things will happen at a support or at a resistance level. Either the prices will break that level of resistance or support the next time it comes to it, or it will bounce off of it. So for example, if I was to go to my chart here, I hope you can be able to see this chart. So what I'll do here, let me see if I can move a few things here so that I can access these tools. Let me see if something I need to do here. All right, so what I can do here, I can insert let's say some lines, a horizontal line. And what we're seeing here is a price ceiling. So there's a time that the prices were unable to surpass this, or the market was unable to surpass this price line. So we went up to it, we bounced off of it, we came back to it again, we bounced off of it, and then we came back the third time, bounced the fourth time, bounced a little off of it, and then we had a breakout. So whether it's a visual support and resistance levels, the ones that you draw, or whether they are calculated support and resistance levels, we are looking at two things. How is the market interacting with that price level once we get to it in future? Is there a high likelihood that you're going to bounce off of it and go down? Or like what happened these other two times? Or most likely this second time. So what happened this second time here? The market came and bounced off of that level. However, the third and fourth time, we eventually had a breakout of that area. So that's what we're looking to do with with the support and resistance. They give us a potential reversal point, and it's for us to observe what is happening when the market approaches that point, whether it will bounce off of it or whether it will break through that level. And examples of indicators that measure support and resistance levels, these are some of the popular ones. So you have pivot points, which are calculated either daily, weekly, or monthly. Those are the best pivot points. And what they do is that you use the previous day's high, low, and close to create 7 potential support and resistance levels that the market will be interacting with the next day. So you use the previous day's data to project the next day. Those are daily pivots. Weekly pivots, you use the previous week's high, low, and close to calculate 7 levels of support and resistance that the market is likely to interact with in the next week. Same thing for the monthly. So those are the pivot points. Then we also have Fibonacci retracements and extensions, and Elliott waves and harmonic waves are part of these Fibonacci sequence indicators. So in general, we just call them Fibonacci sequence indicators because you can just use the basic form, which is the retracement and extension, and you can also use a more complicated version of Fibonacci sequence, which is the Elliott waves and also the harmonic waves. And mind you, these types of analysis seem to have a very good track record. So you may want to look into some of this after the webinar. All right, so those are the first classification. Later on, I'll go to the chart and we'll load a few of these indicators just so that you can be able to see what they're all about. Number 2, or the second type of indicators, are trend indicators. And trend indicators, what we use them for is to measure the trend. So we want to know what kind of a trend we are in. Are we in an uptrend? Are we in a downtrend? Are we in a ranging market or a ranging trend? Because your knowledge of the trend will influence the decisions that you make. If you cannot understand what trend you're in, then it's going to be very difficult for you to project where the prices are going to go. You can imagine you're in an upward trending market and you just even don't know whether the trend is up or down or sideways. So you must be knowing where the general direction of that price is taking in order for you to project what you're likely to do, in order for you to project future price movement and also influence the decisions that you're going to make. So first things first, you must know what trend you're in. So trend indicators calculate the direction and strength of a trend by comparing recent prices to an established baseline by averaging price. So this is what I was talking about earlier on, and I gave an example of the moving averages. So you have different classes of moving averages. You have simple moving averages, exponential, smooth moving average, linear weighted. So there are different classifications of these moving averages, and all what we use them for is generally to gauge the strength of a trend and also give us the direction of a trend. And once we have our moving averages, we can have a better idea of what kind of a market we're in. If the prices are above the moving averages, then we're in an upward trending market. If the prices are below the moving averages, we're in a downward trending market. And if the prices keep on crisscrossing the moving average, which means that we're crossing the average going up, going down, going up, going down, and the moving average line is just a horizontal line. That tells us that there is no trend in the market, and that is the ranging market. So prices are oscillating between, or the market is oscillating between two prices, one above and one below. So those are moving averages. We also have another type of moving average, that is the parabolic stop and reverse. It is a faster moving average. So it tells us whether the trend has changed quickly. And it also gives us some dots on the charts in order for us to know what trend we are in. Are we on an uptrend? Are we in a downtrend? And I'll give visual examples of this in some slides that I have. We also have another one called the moving average convergence divergence, or MACD. Now, these are very popular indicators. There are other trend-based indicators out there, but we'll only look at the ones that you've heard of, or the ones that you most likely come across. And they form like the basis when you're starting out. They form the basis of the indicators that you'll be interacting with. There are hundreds of these indicators, if not thousands of these indicators that have been created, but they range, or they're mostly to do with those 5 categories that we talked about: support and resistance, trend, momentum, volatility, and volume. So those are the trend indicators. Then we have volatility indicators, and volatility indicators usually measure price volatility. Now, these indicators measure the rate of price movement based on the change in the highest and lowest prices. And what they do is that they give people, or they give the traders, an idea about the highness and lowness of price relative to previous closing prices. And examples of this are, so you can have here Bollinger Bands, you can have the average true range, or ATR, you can have the Keltner channels, which I'll just call them Keltner channels, but I'm sure there's a way to pronounce this. So you have the Bollinger Bands, you have the ATR, and you have the Keltner channel, that one, Keltner channels. So I'll talk a little bit more about them later, after we've categorized them into leading and lagging indicators. So number 4, we have velocity indicators. And these ones measure the market velocity, and they identify the speed of price movement. And we can either be using them to identify the speed of price movement, or also the rate at which volumes are increasing. So this one can be used to either measure price or volumes. And they compare the current closing price to previous closing prices. And that representation is given in a line that oscillates between 2 extreme levels. So this line oscillates as the momentum changes. They're used to identify divergence between price and momentum to signal future changes in price. So there is a trading style known as divergence trading, where you're looking at for a difference between how the market is moving in terms of the velocity. So the velocity of price and volume versus the actual price movement. And what happens is that this velocity at times slows down, yet the prices are still rising in the market. And that can signal a change. A possible change in the market trend is due. And these ones are very common for divergence trading. So we have the RSI, Relative Strength Index, we have stochastics, and we have CCI, or Commodity Channel Index. So these are the typical velocity indicators. There are more than this, but we'll just mention a few. Then number 5, we have the volume indicators. And the volume indicators measure trade volumes. Now, in the Forex market, especially if you're dealing with spot Forex contracts, we don't have real volume. We don't have real trade volume. So what we have is tick volume, the number of times the price moved. And the assumption is that the prices move because contracts have been settled. And the reason why we are not able to get a good gauge of real volumes in the Forex market is because the market is decentralized. There is no one central processing point. Unlike the stock market where you have the stock exchange and all orders for buying and selling shares are settled at a central location. So we're able to gauge volumes. We're able to know how many contracts of Safaricom or how many shares of Safaricom have been traded that day. We're able to know how many bids were made for, or how many people wanted to buy Safaricom shares, how many people wanted to sell Safaricom shares. So we're able to gauge that. We're able to get a true volume. But in the Forex market, because the Forex market is an interconnection of the world's largest banks, that means the data that you're getting as volume or tick volume, or if they were to give you data regarding volume, then it will just be based off of the transactions that that entity has sold, the one that you're dealing, or that entity has transacted. Maybe they've transacted buy and sell orders, then they tell you X euros were bought, X euros were sold, but that does not represent the entire market. Remember, the Forex market is a $6 trillion a day market. So it's very hard for us to know the complete volumes. So we use tick volume. However, there are Forex volumes that we have access to, real Forex volumes, and those ones are from the Chicago Mercantile Exchange, or the CME, and there is where they trade Forex futures and options. So Forex futures and options contracts are settled in an exchange. So those ones are not decentralized, but the spot contracts, those ones are decentralized. Swaps and forwards, those ones are also decentralized. So you're not able, in fact, they're private. So Forex forwards and swaps, those ones are private contracts. We get to know information about them. However, the spot market, which is what we're interacting with, can be able to see a few things. However, the volumes that you get are tick volumes. All right, so the number of volume units increases as the trend strengthens. So that's what we are calculating. So we're trying to calculate the rate at which these volumes are increasing versus or vis-a-vis the price movement. So if you see prices are rising, but volumes are slowing down, then we know there's a divergence. However, if we see prices rising and the volumes are also rising, then we know that that is a confirmed trend, or that trend is likely to continue going in that direction. Examples of these indicators, we have the Chaikin oscillator, or CMF. The full name of it is Chaikin Money Flow Index, or the Chaikin oscillator. Then we have another one called the on-balance volume, or OBV. And then we have another one called the volume rate of change, or VRC. I think VORC, something like that. Volume rate of change, VROC. Yes. So I'll put that acronym in the other slides. All right, so those are the 5 categorizations. And from those 5 categorizations, we want to group these indicators into leading and lagging. So first of all, we have to know what is leading indicators, what are leading indicators, and what are lagging indicators. Mind you, leading and lagging indicators are also there in the fundamental analysis. So we have leading indicators in when we're looking at economic trends, and there are also those lagging indicators also when we're looking at economic trends. But that will be for another webinar. So for today, we are looking at leading and lagging indicators in technical analysis. Leading indicators, as this picture suggests, we use them to influence or to get a gauge, or what they do is that they influence future price movement. So we are trying to establish future price movement. We're trying to see where prices are going to go before, or how prices are going to move before they actually do it, right? So it's very predictive. And that's why we say that it's leading. So it moves faster than the price, or it tells us what's going to happen earlier than the market price. So when we see the prices reacting, a leading indicator could have already told us that maybe this uptrend has come to an end, but then we have to wait for the prices to confirm that. So those are leading indicators, and lagging indicators, they just tell us what has already happened. So if the trend has already changed, a lagging indicator will come in to confirm that the trend has actually changed. So they are slower. Leading indicators are faster, and at times they're even early. They tell you something before it happens, but lagging indicators only tell you what's either currently happening or what has just begun happening. All right, so let's group some of these indicators that we've looked at into leading and lagging indicators. So leading indicators give early signals of possible trend changes before they occur. Therefore, they lead the price, and they predict prices by using shorter referencing periods. So indicators that identify turning points are also classified as leading indicators. So support and resistance indicators, that first group that we looked at, pivot points, Fibonacci retracements, Elliott waves, that Elliott wave theory, including harmonic waves, those can be classified as leading indicators because we have identified a potential price ceiling even before the prices reach that level. So we already can anticipate what's going to happen when the prices reach that level. So that is a leading indicator. So anything to do with support and resistance, anything that projects future support and resistance level is a leading indicator. We also have some of the velocity indicators like stochastics, CCI and RSI. CCI, we call it the commodity channel index. RSI is the relative strength index. So these indicators are also leading indicators. We also have Bollinger Bands and MACD. However, these two can be categorized as both leading and lagging. So there's an element of theirs that can also be lagging. And I'll describe this when we get to the charts. So Bollinger Bands, moving average convergence, divergence, which is the MACD. We have some of the volume indicators like the CMF and the OBV. That is the on-balance volume. So most of those indicators that you are looking at can be categorized as leading indicators. What then are the lagging indicators? So the lagging indicators are the ones that give signals that trail behind price action, and they are used as confirmation tools. So they are used to confirm trends and patterns, and they give signals after the trend has reversed, or after the trend reversal, or once the new trend has begun its movement. So the most common type of lagging indicators here are moving averages. The different classes, the different types of moving averages we mentioned: simple moving average, exponential, smoothed, linear weighted. Then we also have parabolic SAR. There's some people who use parabolic SAR as a leading indicator, however it is classified generally as a lagging indicator. Here we also have our MACD as well, and the Bollinger Bands. And we have another one called the average true range. Ichimoku Kinko Hyo, this is a Japanese word, including this other one, Heikin-Ashi candles. So I hadn't mentioned about Heikin-Ashi candles earlier on, but Heikin-Ashi candles are part of trend. These are part of trend indicators, same thing as Ichimoku. So Ichimoku or Ichimoku, it just depends on how you pronounce it. These two can be classified as trend indicators. So they're in the second category, trend indicators. All right, so from there, I would like to go to another slide here that now shows these indicators. So RSI, we said, is a leading indicator. Now, what does it do? It shows the conditions of a security in relation to it being overbought and oversold. So that's what it does. It shows us overbought and oversold conditions. So when the prices rise too quickly, there's a high chance that people are going to take profits and the prices are going to start falling. Same thing, if the prices fall aggressively, there are people who are likely to start taking profits. Those ones who short sold, they're likely to start taking their profits, and that means they're buying back, and that will cause the prices to rise. And this is useful for traders who like to buy low and sell high because the values are plotted between 0 and 100. So 0 is considered oversold, 100 is considered overbought. But the two price lines that we look at in order for us to know that whether we are overbought or oversold is 70. So between 70 and 100, it means that the market is in an overbought condition. And if we go below 30 with the indicator, if the indicator goes below 30, so between 30 and 0, it indicates that the market is in an oversold. So here it's saying underbought, in that case can be an oversold condition. So that is the RSI. And on the charts, if I could just go to the charts, I'd like to insert RSI here so that you can see it. Now, in the calculation, it's going to be calculating the last 14 closing prices. And that is how it's going to gauge whether the velocity is too high. Let me delete this other. This is the CCI. Let me delete this indicator. So this period here when the market was overbought, if you look at this situation here, this area here, we were above 70. And when we went above 70, what happened is that the market started slowing down. And eventually we saw a change in the trend. So you see, RSI was already telling us we are overbought, so we should start to see the prices fall. And we had even started to see the indicator go again below 70. Came back up again above 70 and then went back below. So already this period here, when it went above 70, it came back. It was telling us that the velocity in the market is too high. So we should see a cool off very soon. So we should see the prices starting to go down. And that's exactly what happened. There is a time maybe for a low. There's also another time here when it went above 70 and it told us that we were in an overbought condition. So prices should start to cool off and we should start to see prices fall. Same thing here. You can see we went into the, if I can be able to draw horizontal line here. When we went below 30, it was telling us that we're in an oversold. So above 70 overbought, below 30 oversold. So if we're in an oversold condition in the market, it means the prices have been falling too quickly. We're likely to see a cool off and prices are going to rise. And as you can see, just shortly after that, we saw the prices rise. And that's why we're saying that RSI is a leading indicator. So it's telling us something is likely to happen before it even happens. All right, so that is RSI. We have Bollinger Bands, and we said that Bollinger Bands are both leading and lagging. So Bollinger Bands are used to measure the highness or lowness of the price relative to the previous closes. And the ability to gauge the volatility helps to analyze the possible risk involved. As the bands move closer together, the volatility decreases. And as they move further apart, the volatility increases. So we use Bollinger Bands to identify either loud markets, so those are volatile markets. Remember, it's a volatility indicator. So we use it to identify volatile markets. And also, well, not just volatile markets, but using the indicator, we're able to identify whether the market is in a state of high volatility or in a state of low volatility. And that is given by the bands. So let me go to the chart so that I can explain this. Let's insert the Bollinger Bands. Let's go in this group here of trend, Bollinger Bands. So there are these green ones here. Let me just change the color. Let's change it to something a bit lighter. So those are the Bollinger Bands. So these times when the bands are horizontal, it tells us that we're in a ranging market. But when the bands separate, it tells us that we're in a trending market, or the market has broken out. So in that case, the market is in a state of high volatility. So we use the bands just to be able to identify, are we in a ranging market or a trending market? And if the bands are horizontal, we are likely in a ranging market. So we need to adjust ourselves to a ranging market. If the bands have separated, that means they've expanded. It means that we're in a trending market or a market that has just gotten a breakout. So how do we use it for as a leading indicator? Because of these bands also act as support and resistance levels. So when we get to the upper band, we're likely to see the prices cool down. When we get to the lower band, we're likely to see the prices starting to rise. However, during a trending market, the prices can stay on either one of these bands for an indefinite period of time. So this aspect of using it as support and resistance levels, using the upper and lower band as support and resistance levels, which means when we get to the upper band, we can sell off. When we get to the lower band, we can buy. That only works when the market is ranging, when the bands are horizontal. But the moment the bands expand, it means that we are likely to incur losses. If, for example, here we decided to buy because the market came down to the lower band, we bought, you can see the market went against us for quite a number of sessions. So that is the Bollinger Bands. And you can use this together with the middle band. This middle band here is a 20-period moving average. And we said the moving averages are lagging indicators. So let's say you're in this situation where the market has touched the lower band. And it means that you should be looking for buying opportunities. If you bought, the market would have gone against you. Remember, in this case, the Bollinger Band is a leading indicator. We're using it as a leading indicator. So how we can be able to reduce our risk is by merging a lagging aspect or introducing a lagging indicator into the mix so that it's able to reduce our risks. So for example, here when it's telling us to buy, we would wait up and until the prices go above the middle band, which is the moving average. So the moment the prices rise above the moving average, then it's safe for us to buy because it means that the low price has already been established and now the prices are likely to rise. And we can do the same thing when we get to the upper band. Instead of us selling, once we get to the upper band, we wait up until we get the confirmation that the prices are now starting to go down, and that confirmation will be gotten when the candle starts to move below the middle band. The middle band is the 20-period simple moving average. So that said, leading indicators are very early. So they'll tell you something early, and you might get caught up in the wrong move because they're prone to very many false signals. So as a way of filtering out those false signals, we introduce the lagging indicators so that when you have a mix of a leading indicator and a lagging indicator, and you can decide how lagging you want your indicator to be. Maybe you want it to not be so lagging, so you can use a smaller time frame. If you want it to be very lagging, you can use a larger time frame. So you can decide how quickly that lagging indicator should confirm for you or confirm to you about price movement. So those are the Bollinger Bands. Now, due to time, I may not be able to go through all of them in terms of the charts, showing you how we have them on the charts. So what I'll do, I'll just use the slides that I have. We have the stochastic oscillator. So this is a volatility, a velocity indicator or a momentum indicator, and it's leading. These stochastic indicators are designed to indicate zones of overbought and oversold conditions. So stochastics is similar to RSI in that regard. Stochastic indicators also point out possible reversal points. And if we were to look at this figure down here, the areas for overbought and oversold in stochastics are different. It's 80, above 80, 80 to 100 is overbought, below 20, so 20 down to 0 is oversold. So the moment we are in oversold, we have again, we wait for these two moving averages to cross each other. As you can see, there are two lines. We have a green one. Is that green or blue? We have a blue one and a dotted red. So these two are moving averages with a shorter time period. So we have a 5 and a 3 moving average. So they're very fast. And when you have very fast moving averages, they are no longer, lagging. They can actually be classified as just right on time or even leading. So when we have this crossover here, when we were below 20, and this was telling us, all right, we're oversold, so we should be looking to buy, and we wait for a confirmation using the stochastic, the 2 moving averages for stochastics crossing each other. When they cross over and start exiting this oversold area, that confirms to us that prices should rise. And at that time, you can see it was around this period here. So the prices had not even risen. So the prices had not even started going up, but it was already telling us that the prices should rise. So it's up to us to decide whether we're going to enter instantly or whether we're going to wait a little bit longer. So as you can see, it has 2 aspects to it. There's the overbought oversold, and there's the moving average crossover, which tells you that it's now time to make your decision. That is the stochastics indicator. And it's also the same for sell opportunities. So when we're above 80, we're in overbought, we should be looking for sell opportunities. We wait for the stochastic indicator, stochastic averages. Those are the 2 moving averages to cross each other going down. And that then confirms to us that it's time for us to make our move. And as you can see, it's leading. It tells us to start selling even before the prices start to fall. So that is stochastics. It's very volatile in terms of it giving you very many signals. So you would need to use it in relation to a trend. Best way of using stochastics is not just for buying and selling each time. Each time we go to the overbought, we sell. Each time we go to the oversold, we buy. You need to identify the trend. Then if you're in an uptrend, you only look for those situations where we're getting buy opportunities. Why? Because on an upward trending market, there's more opportunity to buy than there is to sell. We're likely to make more money and incur less risk if we're buying in an uptrend as compared to if we're selling in an uptrend. Then we have the Fibonacci retracement lines, which we said are leading. And this is a method of tech analysis that looks to find support and resistance levels on a trading pair, on a trading instrument. That would be a Forex pair. The concept is simple. Markets react or retrace by smaller portions of a larger move, and these portions are predictable. We consider Fibonacci retracements as discount levels. So let's say the prices have fallen and you've missed out on that opportunity to short sell. So you're already anxious, you want to sell, but you know that the prices have fallen too far down. So that would not be a good place for you to sell. So what you're looking for is a discount. You want the prices to rise up a little bit so that you can be able to short sell at a better price, at a higher price, because you don't really want to sell at these low prices. So Fibonacci gives you possible discount levels in the form of these ratios of 38.2, 50, and 61.8, which are the most common Fibonacci retracement ratios. So Fibonacci retracement is a series of patterns that are continuous, and we use it to get into a trend. So Fibonacci retracements are used to get us into a trend. So they're not for trend reversal. Fine, you can use them for a trend reversal, but they're mostly used to get into a trend that is likely going to continue moving in that direction. Then we have the moving averages, which are lagging. And these are used to identify trends and confirm reversals. They also provide for moving or dynamic support and resistance levels. So here's an example of moving averages. So we have 2 of them, a 50 period simple moving average and a 21 period simple moving average. So the 50 is calculating the average of the past 50 candles or the most recent 50 candles or the most recent 50 closing prices. And this other one is calculating an average of the last or the most recent 21 closing prices. So when this SMA 21, because it's faster to react to prices because it's only looking at 21 closing prices, 50 is a bit slower. So when the 21 crosses the 50 going down, that gives you a confirmation that there is a lot of momentum on the downward side, or the prices seem to be trending down. So in that case, we can start looking for selling opportunities. And when it crosses back, and it crosses above the 50 going up, it tells us that we most likely reached our resistance, not our resistance, our support level. We most likely reached the bottom of that trend, and we're now likely to start a new trend, which is an uptrend. So the moment you get the crossover, that signals to you that we are now in an upward trending market, and it's now up to you to determine at what points you are looking to buy into that uptrend. We have the commodity channel index, which is also this one is leading. Remember, this one was lagging. So the moving averages, we had classified them as lagging. And the reason for this is because the upward move has already started. By the time we're getting the confirmation, the market is already moving. Same thing here. The prices had already started falling by the time we got our confirmation. So CCI is a leading indicator, and it's an oscillator that helps identify price reversals, price extremes, and the strength of the trend, and to confirm the strength of the trend. So this is how it looks like, and it oscillates above and below these two levels here. So above 100, that would be a strong uptrend. Below 100, that would be a strong. Below minus 100, that would be a strong downtrend. So that is the CCI, Commodity Channel Index. And it's used as an oscillator like RSI and stochastics. We have another one called Average True Range, or ATR. And this is a lagging indicator. This indicator does not provide an indication of price trend. It simply measures the degree of volatility. So ATR is not used to determine whether we should be buying or selling. ATR is used as a risk management tool because it helps with the placing of stop losses based off of the pair's volatility. So if you've ever traded, and this is something that happens a lot for new traders, you're trading and you find that you've placed your stop loss somewhere, maybe you've gone long or you've bought into the trend, but then the prices fall down, knock out your stop loss, and then later on they rise and go in the same direction you had predicted. And this happens over and over and over and over again. So as a way of ensuring that you are placing your stop loss levels in a correct place, you need to first of all assess the volatility, because this is a volatility-based indicator. So you need to know what is the volatility of the market within the last few closing prices or the last few candles. So how many pips does or how many pips do these candles average in the current situation? So it tells us the average trading range of the market over a prescribed period of time. So for example, if the ATR, if we're looking at an ATR of the last 20 candles, we're looking at, what is the average number of pips that the candles are moving over the last 20 candles. So we're looking at an average over the last 20 candles. So if you get a figure of, let's say the ATR is saying that it's about 34 pips or 344 points, that is what is the average. Then if the market moves more than the average, so let's say we get a very aggressive move, maybe the market goes 107 pips, which is double of, but it's even triple of this 34 pips, because this is 34 pips or 34.4 pips. So this has gone triple that. So it means that there's too much velocity in the market. We are likely to see a cool-off taking place. And we also use ATR for placing stop losses. So if we know that the ATR maybe over the last, this is an ATR of only 14. So if we took an ATR of maybe the last 20 and we found that it was around 50 or so pips, that should give us an idea of how to place our stop losses based off of ATR. So that there are times where we'll have to be hit, like in this situation, we have still been hit because the market has gone 3 times the ATR, the average true range. So that means even if you had placed a stop loss above ATR, so if the ATR is 34 pips and you place a stop loss at, let's say, 40 pips, so you're expecting not to be hit. And over this period of time, you've not have been hit, but once you started seeing this aggressive move, which took place maybe at around midnight or so, then unfortunately you'd have been hit. So there's no pure way of avoiding losses. You cannot avoid losses 100%. There's still a point where the market will get you. And the goal is to ensure that when that happens, you end up losing as little as possible. So we have the parabolic SAR, which is lagging, and this is how it looks like with the dots. So if the dots are above the market, it means that we are trending downwards. When the dots switch from being above the market to being below the market, it means that there's a possible trend change. As you can see, it's lagging. By the time we got this dot to confirm to us that we're going up, this was quite a number of candlesticks away. This is where the market bottomed out. Then it started rising. So by the time we're getting this dot that is forming below the market telling us we are now on an uptrend, it was a few candles later. So that's why it's a lagging indicator. All right, so we are short on time. So let me just quickly go through the rest. We have this CMF, or the Chaikin oscillator, and it monitors the flow of money in and out of the market. And comparing money flow to price action can help to determine tops and bottoms in short-term cycles. So here is our CMF, and you can see the indicator is telling us that the volumes are going down. Remember, it's a volume indicator. So we were going on an uptrend. We are in an uptrend. The volumes were rising, but then they seem to be slowing down. And this is what we were calling divergence. So we are seeing the volumes are telling us that the volumes are falling. However, the prices were still rising. So this is a leading indicator. It tells us the volumes are going down. So prices are likely to follow suit sometime later. And as you can see later on, the prices did follow suit. We have the on-balance volume, which is also leading. These indicators attempt to measure the level of accumulation or distribution by comparing volume to price. So if you look at this, it's just to confirm to us the trends in the market. So if you look at the OBV, it's flowing downwards and the prices are also flowing down. When the OBV is going up, slightly later on, we do see the prices going up. So we just use it to ensure that the volumes are matching the prices so that we can, and whenever there's a divergence, what we're calling a divergence, these volumes start going down, yet the prices are going up, then we know at some point the prices are going to follow the volumes. Because remember, we said that volumes are the ones that influence price. If there's more demand than supply, then prices will eventually rise. If there's more supply than demand, then prices will fall. Then we have the volume rate of change, and it highlights increases in volumes. And these normally occur at market tops and bottoms or during breakouts. So if you see at this period here, when we had this bottom, we had a market bottom here, and what happened after that is that the prices rose. So we had a bottom there, then there was an increase in volume. So what happened is that the prices skyrocketed. So we reached this bottom and we had prices skyrocket. The next time we had an increase in volume was around this area here, and eventually the markets decided to turn. So this rate of change can be used either to identify reversals, just like the support and resistance levels, or it can be used to identify breakouts. Because at any particular resistance or support, the market can either bounce off of it, or the market can break right through that support or resistance level. So when we see an increase in volume, it means that we need to pay attention to what's happening to see whether the market will break that area or whether it'll bounce off of it. And at that time, we'll be ready. Look at this other situation here. This was around this time here when the market had again reached that resistance, and there was an increase in volume, and we did see the prices go in the opposite direction. So in this case, it's an increase in volumes, selling volumes. So all it does is that it just measures volumes, be they buying volumes or selling volumes. And then we have the MACD. So let me, due to time, let me just go and explain what it is. So the MACD is both a leading and a lagging. If you're using it as a leading indicator, we can use these faster moving averages. When they cross over going down, like this blue one crossing the red one going down, it signals a likely turning point that the market has arrived at. So it means that the prices could start falling. And as you can see, it was almost right on time around that area there, and the prices fell. And again, when the blue one crosses the red one going up, it could signal that the market has bottomed out and we're likely to see prices rise. However, there is also this zero line here, and this zero line here is lagging. So there are people who use MACD either as a leading indicator using these crossovers, or as a lagging indicator with regards to the zero line. So this zero line that you're seeing here is just a flat line there. And the moment these two averages are above the zero line, it means we're in an upward trending market. The moment these two moving averages, these red and blue lines, are below, then it means we're in a downward trending market. So that's a later confirmation, because you can see here we got an early signal to buy, but if we waited for both of these averages to go above zero, this zero line here, we were getting our confirmation much later up here. So you can either use it to come in early, but remember, if you come in early, there are very many false signals, or you can use something else to confirm a bit later that the prices have actually started to go in that direction. All right, so due to time, I may not be able to complete the entire list. So forgive me for that, but I'd like for us to go to mention a few things about, or to go back to this slide to mention a few things about these indicators. So leading indicators, what is the purpose of leading indicators? The purpose is to predict turning points in the market. The signals are usually frequent, so you get very many signals. And because of this, the reliability is often misleading because you're getting so many signals. And the reaction to price changes is fast. But when we come to the lagging indicators, the purpose of lagging indicators is to confirm trends. The signals are fewer, in this case, they are rarer, and the reliability is typically more accurate. Why is this? Is because we are confirming what's already happened. So the turning point has been established, the market is now moving in a particular direction. So we're likely to get things right when we come in after confirmation using the lagging indicators. And the reaction to price changes is typically slow, and that's why it takes time for us to get our confirmation. All right, so what are the points to consider when selecting these indicators? The first point is the type of instrument you're trading. Are you trading a stock index? Are you trading a forex pair? Even if you're trading forex pairs, how volatile are those pairs? What's the volatility of those pairs? So you need to know the type of instrument that you're trading so that you can best adjust the settings of those indicators to suit the kind of market environment that you're in, or in this case, the kind of instrument that you're trading. There are those markets or those pairs that are very volatile. So using RSI in such a market, you're most likely going to be getting false signals. You'll get a lot of false signals because it tends to have a lot of velocity. Maybe that pair has a lot of velocity, so you're likely to fail with the oscillators. So you're best using maybe the trend tools, or maybe the lagging indicators for that. Also know the nature of market you're in. Your trend determines a lot. If you don't know what trend you're in, then that's a problem for you, because you could be using these indicators in the wrong way. You could be going against the trend and you don't know that you're going against the trend. So know what trend you're in. Are you in an uptrend, downtrend, or ranging or a ranging market? And then from there, be able to adjust the indicators to suit the market environment you're in. With regards to the trading style, this is also important. Are you someone who trades? Are you a swing trader? So are you looking for reversal points in the market? Or are you a trend trader? Do you ride the trend? So this will influence the kind of indicators you will use, and also what you want to measure in the market. So what is it that you want to measure in the market? Are you measuring volumes? Are you measuring momentum? Are you measuring trend? Are you measuring support and resistance? That will influence the indicators that you will select. So just before I open up the Q&A section, I know we've extended a little bit. To conclude, the success of the tool depends on the purpose that you are using it for, and also the market conditions that you're using it in. There is no holy grail indicator. There's no indicator that is perfect, that gives you perfect reversal points if it's a leading indicator, or gives you perfect confirmation every single time if it's a lagging indicator. So there is no one indicator that is perfect, and you will have to adapt the indicator by adjusting the settings to suit the environment that you're in. Success in trading and investing is determined by how you manage risks when chasing after profits. So it's not how perfect your indicator is, because at some point it's going to fail. So what determines success is how you manage profits and losses. All right, so that concludes the end of my presentation. So let me have a look at the questions, if there are any questions that I can answer. Stella was talking about the slide on the third indicator. Which indicator was that, kindly? What would be the best time frame to read these indicators for a day trader, since they tell different stories on different time frames? Correct. So if you're a day trader, then chances are you're going to be using the smaller time frame. So that should be 4 hours, 4-hour charts and lower, maybe 4-hour charts to the as far down as the 5-minute chart. Again, remember, it depends again on the nature of the market. So if you're in a trending market and you're using ranging indicators, then you're still going to get bad results anyway. So you need to first of all identify the trend, even in that smaller time frame, be it from the 4-hour chart down to the 5-minute chart, and then from there use the indicators that can best get you into that trend. Why is the fibs more accurate, and what time frames? Now, there is a lot of debate as to why the Fibonacci ratios tend to be accurate, and it's because that the forex market is run using an algorithm, right? There's no way there's one person who is, transacting all these orders or confirming all these orders in the banks manually. So this, buying and selling that the banks do, because they're the major market makers, all this trading is being facilitated using algorithms, complex algorithms. And if they're algorithms, then they are mathematically based. So that's why you see some of these mathematical calculations like Fibonacci and Elliott waves and and the like, they seem to rhyme well with highs and lows being established in the market. There's EG who is asking any upcoming session of practical application of the same. Yes, hopefully we'll have a webinar on this in future, because we have I think March left, and then from April we'll begin a new list. So if you would want a webinar for practical applications, especially coming up with strategies, like how to define strategies for MACD, how would we come up with a strategy based off of MACD or based off of leading and lagging indicators? What I can do, if you can request that, maybe in the chat area, we can organize for such a webinar, maybe in March or in April. Are these indicators available on MT5? Yes, they are available on MT5. This platform that I'm using is MT5. I'm using a different computer from my computer. That's why I was a bit late. My computer, it's almost like it crashed. So I had to do a lot of adjustments. So I was not able to log into my Scope Markets platform. So what I did is I downloaded the stock version of MetaTrader 5 from the company that provides MetaTrader 5. So this is MetaQuotes. This is MT5. So it's very simple. It's exactly the same as your Scope Markets. Can we use OBV to visualize or identify Elliott waves? You could, however, Elliott waves do involve a calculation. So you're better off learning about the calculations that are involved in Elliott wave theory. What do you mean by risk management? That is managing your stop losses, how you manage your risk in terms of stop losses. So ATR is used to give you an idea of how many pips you should use as your stop loss. So if the ATR is about 35 pips, then that means your stop loss should be above 35 pips. Why is that? Because the market seems to be moving with an average of 35 pips a candle. So if you wanted to place a stop loss and you don't want the market to spike and knock you out, then you use the ATR, depending on the time frame that you're in. Even on a 1 hour chart, it will give you ATR based off of the 1 hour chart. If you're using a daily chart, it will give you based off of a daily chart. Clement is saying, you said the indicators are not always certain, but I was wondering if you use both lagging and leading indicator and they show the same trend. Wouldn't that be like 95% certainty? The markets can always decide to change. You could place your indicators and they're telling you exactly the same thing. You've gotten your leading indicator, it gave you an indication early, so you are prepared to execute. The lagging indicator confirms, you execute. Then the prices go in your favor, maybe 10 pips, but you are targeting 40 pips. Then after 10 pips, the prices, the momentum runs out, the steam in the market runs out, and the prices start to fall. So there are other things that influence the market that we're not aware of. For example, there is the other side of the Forex market that is non-speculative. There are companies that are buying currency because of their business, not that they are speculating about price movements. So there could be huge orders that are being settled in the market, and that could cause the prices to go against you. So that's why I'm saying that there is no 100%, but you can be able to look at the mix, tweak those indicators to give you a very good mix between leading and lagging indicators that can give you a high accuracy, but it's not going to be 100%. So yes, you can get even to 95%. There are certain strategies that even go quite high, even to 99%. However, what usually happens with a high accuracy strategy is that the risk element is an afterthought. So what happens is that the stop losses are very far away. So when you get knocked out, you end up losing the profits that you have made from so many trades. So even as you're looking at accuracy, ensure that your losses are smaller than your profits, because it's counterintuitive if you're always making like 5 pips, but then when you lose, you're losing 30 pips, 40 pips. It means you're doing zero work, or you're going 1 step forward, 3 steps back. All right, so thank you so much for your questions. For any other questions that I haven't answered, our contacts are, I believe, my colleague Sylvia, who is here with me. She's the one who's been moderating the chat room. So you can, I think she's given us, she's posted our contacts. So for any other queries, you can contact us via email addresses that she's posted there, and I will definitely answer. Also, if you can join the Telegram group for Scope Markets. If you're not already in the group, kindly join the group so that you can also post your questions there, and myself and the other traders in the community can also be able to respond and give you further guidance. So thank you so much. We are really out of time. Thank you so much for your attendance. I do appreciate the time that you have taken to attend this webinar. It's a Friday, and that just shows commitment from your end. So thank you so much. Have a good weekend and join us every Friday. It's an STL Friday. We'll be having webinars, whether we are doing presentations such as this or whether we are getting international traders to come and tell us how they usually trade. So if you wanted even a practical example, do join us every Friday, because we could be having a guest who uses technical analysis, and he or she will describe how they derive trading decisions. Thanks again and enjoy your weekend. Oh, before I go, there is Jacqueline who is asking about Scope Markets Telegram link. What you can do is you can go to Scope Hub. Go to Scope Hub. I believe the website is www.scopehub.co.ke, and you'll be able to get the link there to Telegram. Yes, scopehub.co.ke. So if you go to that address, you'll be able to get the link. All right, so thank you guys. It's time for us to end the webinar. God bless.